want to add before we go into our nature-based solutions panel with Rich Gilmore, Kurt McFarland, and Prati Porwal? No, everyone's good? Okay, so I think I will start off with Prati. Have you, introduce yourself. He's with Haston Partners, sort of environmental services, quite vertically integrated, should I say? I think that's accurate, and I'll let you give the description. We also, then have Rich Gilmore from Carbon Growth Partners. They launched a fund last year. I think it had something like a 60 some odd % return in its first year, so quite good. And Kurt McFarland, who does a fractional CFO business and in a number of different regeneration type of areas. So that's our panel today. And Prati, I'll kick off with you introducing yourself and telling a little bit about you and Haston.
Great. Yeah, thanks a lot, Matt. So here I'm representing Haston Ventures. We are a nature-based carbon removal project developer based in India. So we're starting up projects in India, but we have had experience in executing small-scale urban forestry projects outside of India as well. And the idea for us is to essentially create an organization that can generate originate, design, implement, and manage institutional scale nature-based projects. One key gap that we saw on the supply side of the carbon credit markets, especially in the nature-based space, was the availability of high quality credits that have very clear additionality, permanence, durability factors. Most of the current originators either come from the nonprofit world, or if they're for-profit corporations, then they are primarily monoculture timber plantations. And neither of these models are well suited to sort of support the environmental targets that we as a planet have. And there was a clear need for business model innovation on that front to sort of have organizations, private players who can deploy the right kind of technologies, as well as manage the operational complexity of working on the grounds, especially in developing markets, in a transparent, reliable, trustworthy manner, which is one of the sort of key requirement that any institutional investor is going to have when they are due diligencing projects and thinking about investing significant sums of money. On the demand side, there is a fair amount of money that is getting allocated or earmarked, but not much transaction is happening right now because of the absence of this layer of very high quality trusted supplier base, which is something that's going to evolve over the next few years. And that's been the primary thesis for Haston, to be in the origination space. And as the sort of ecosystem evolves, we do intend to sort of become more of a supply side platform, wherein we will partner with several other high quality developers in India and outside to ensure that there is a platform that is able to provide very high quality, high integrity carbon credits to investors. And that's how sort of start accelerating the process of investments into nature-based solutions space. So that's a quick one on me. Prior to Haston, so I primarily look at commercialization, monetization at Haston, and prior to that, I was based in Hong Kong for about 10 years trading bonds. Yeah.
Cool. Yeah, it's a good good overview there. Why is my so Rich, why don't you introduce yourself? Originally we were going to have your partner Charles, who I know is, even though you guys are based in Australia, right? Charles is an American, and I think you might be as well. Why don't you tell us a little bit about yourself? Oh, you are? Okay, so we good. We have two Aussies on the panel, and then Prati's from India. So it fits into our time theme and our time zone. So we actually because I had a few fake Aussies down there with Sarah and Marin, you know.
So I'm Rich Gilmore. I'm the CEO of Carbon Growth Partners. My partner Charles Bedford, one of the 4 founders of the organisation, and I, along with about half of our team, actually, are former executives of the Nature Conservancy. Everybody on the call will no doubt know TNC, and we're now specialist investment managers in what other people would refer to as the voluntary carbon market. We would never refer to it as the voluntary carbon market because emissions reductions are not voluntary. It's the VCM is the verified carbon market, and it's a robust system that needs to scale and scale quickly, and that's part of our role. So we left TNC, as I said, 50% of our team are ex-TNC folks, and we left for 2 reasons. One was we felt, like Prati said before, there's a big gap to fill in both the supply side of high quality carbon abatement, not just nature-based solutions, but in particular nature-based solutions, and a gap in financing those solutions. And there's plenty of money. You know, money is infinitely abundant globally, but you need to be the right kind of money, you know, patient, values aligned, understanding the market. And so that's what we try to do. We're specialist investment managers in the VCM. We have a spot portfolio of something like 22 million VCUs, I guess, so 5% of the global inventory. And we think about the carbon markets as a spectrum or a continuum of complexity, impact, risk, and reward. If you're operating down the secondary trading end of the VCM, that's not a zero impact thing to do because it's providing liquidity into a market that needs liquidity, all the way up to origination, financing origination of new projects like the ones that, you know, Prati and his team do. And so we exist to, you know, generate financial returns for our investors and positive impact for the planet by serving 3 key groups. As I said, our investors are looking for return through the capital appreciation and underlying value of a carbon portfolio. Project developer partners are looking for finance, in particular early risk-on finance. If you've already got a PDD or you're close to issuance, money's not a problem, but funding early stage. And then the third audience is corporates who need an emissions reductions offset and want to have a lot of confidence in the integrity and quality of that offset. Because we're passionate conservation finance folks, we only invest in high quality, high integrity credits, whether they're and projects, whether they're technology-based solutions or nature-based solutions, and so then we can deliver those abatement solutions in a high integrity way. And Matt, as we get through the afternoon, happy to dig into more about that. But that's who Carbon Growth Partners is.
Cool. So, you know, just for everyone to understand, we're talking institutional grade investment here, not just a little small mom and pop. Institutional money is going into that and has really, quite frankly, done pretty well so far from what I can tell. Kurt, do you want to introduce yourself a little bit before we start?
Absolutely. Thanks, Matt. Nice to be part of this conversation. So I'm Kurt McFarland, and I run a CFO services firm called Regen Impact. We serve clients in the US and Australia that are in the climate tech and environmental services space, companies that are looking to have an impact and shift the needle on the biggest challenges that are facing our planet. So one of our clients who I've been engaged as an interim CFO since last year, that's very relevant to this conversation, is called Flint Pro, and they are a carbon accounting and greenhouse gas modeling platform, firmly in the MRV, the measure, report, and verify space, and certainly giving investors and governments and all stakeholders confidence in the quality and value of not just carbon credits, but overall all activities that go into reducing emissions and accounting for existing carbon stocks and methodologies to enhance or improve mitigation is incredibly relevant. And I can certainly speak speak highly of the platform that's been created at Flint Pro, and the company's recently closed a $9 million US Series A transaction that'll be announced soon. And yeah, it's certainly testament to the need that we're seeing in the market for again, being able to have confidence in the activities that large landowners and asset managers are needing to undertake. And we see a lot of people sort of coming. There's a lot of room for education in this market, as well as all stakeholders move down the curve of like what needs to happen.
Cool. So I know the carbon market has been under fire some recently, different articles, different analysis, which has shown, maybe it hasn't delivered, all it was hoped to deliver. But can you guys describe a little bit, maybe Rich or Pratty, where like some of these projects or most of these projects wouldn't get off the ground and you wouldn't have trees planted and forests protected without the carbon market? Is that a fair assessment to say in a lot of cases?
Yeah. Yes. And I think it's really, really important to understand what is being alleged, if you like, about the performance or otherwise of the carbon market. And because this is focused on nature-based solutions, let's think about REDD+. And what's not being alleged? What's not being alleged is that carbon outcomes weren't achieved. Whether a wind farm was built or a forest was protected or a tree was planted is verifiably observable at low cost in real time. What is being alleged is that, having been proven, those carbon outcomes are no longer additional to business as usual. So it's really, or additional, to whether the threat to that forest had been appropriately calculated. So it's really important to remember that even in the sort of criticism leveled by famous article in The Guardian in January, the background research found that every one of those projects prevented deforestation. So let's make sure we have that baseline understanding. After that, you're then into an accounting question about whether the amount of emissions reductions that's being claimed is appropriate to the baseline. But yes, I think it's absolutely true to say that those projects are successfully preventing deforestation, and they would not have happened without the presence of climate finance or carbon markets. And I think Prati mentioned something earlier, which was really interesting around institutional scale investment. If you think about how projects were established in the early days of REDD+, Prati said they were established by NGOs, entrepreneurs, individuals, small businesses, bootstrapping it to try and get these projects funded, and get them, verified and issuing credits. The new money that's coming into the market is institutional grade and has institutional expectations. And so if there is an issue with the quality of nature-based solutions projects, and it's not perfect, we need to improve, you can almost think of it as the quality of the projects is going to be solved by the quality of the money coming in. Institutional investors are going to have very high expectations around quality and integrity. And so, yes, the market needs to improve. And yes, you're also right that these projects wouldn't have happened without carbon markets, and they are successfully preventing deforestation. It's an accounting question that we need to solve for.
Sure.
Yeah. Matt, did you have anything to say about that?
No, I could add something, but did you want to add something first?
Yeah, sure. Correct. Yeah, I just wanted to sort of add to what Rich mentioned. Obviously, like the way we think about it is that like these projects are 100% like adding positive value to the planet, right? Like the only question, as Rich mentioned, is whether they're being accounted for the right way or not. And my view on that is essentially that it's a market inefficiency that exists right now, right? And as more and more institutional and high quality money comes in, and also on the other end, so that's the demand side, but on the supply side, as more and more institutional players start building projects the right way, which are geared towards actually meeting these expectations, then these inefficiencies will sort of keep on narrowing down over time, right? And the carbon markets have sort of gone through a few such cycles of boom and bust, trying to find the right kind of path forward in terms of measurement, monitoring, verification. And some of it is technology related, but a lot of it is outside of the technological purview, just in terms of building the right sort of processes which are standardized and which everybody follow as well, right? And that level of sort of even the fragmentation that exists right now on the registry end, some of those market structure issues will have to get resolved over time for the next hopefully few years to start have a much better functioning market structure overall that is not sort of that is reducing the transaction cost as much as possible. Right now the transaction costs are too high, and that's an indicator of very early stages of sort of market development. Even now is what ours has been so far.
So when you talk about inefficiencies, you're talking about the high transaction costs, or you're talking about something else in addition to that?
High transaction costs, bad actors, not enough monitoring in certain cases as well. And you see these sorts of cases pretty frequently, at least from our vantage point, where there are no clear sort of FPIC processes being followed by several people. And a lot of people, as Rich sort of also alluded to, like started off as not thinking about it as a project that was specifically delivered geared to sort of deliver returns to any investors, right? So most of the nonprofit organizations are used to just structurally take money and spend it without having to sort of prove accountability 10, 20, 30 years from now. And all of that, these are essentially incentive misalignments that existed in the structure, which hopefully will get resolved over time. So yeah, I mean, inefficiencies exist at multiple levels in the market, and those will have to be cleared out. And a lot of sort of positive developments and momentum is building up in that respect, at least both in terms of the story and narrative, but also in terms of the solution set that is coming up into place using technology.
Okay, I'm going to pose like two sort of things that are maybe counterbalancing or work in a little different way. So in terms of the counting for carbon offsets, the issue I have is with avoided emissions, where you sort of have this 1 + 0 or 1 - 0 equals 0 mentality, right? So if it's just an avoided emission, the forest didn't get cut down, or the new coal-fired power plant didn't get built, right? You're not actually drawing down emissions necessarily. You know, if you put in a solar plant, you know, instead of a coal-fired power plant, but somehow a company is claiming credits for that, right? And then another, but on the flip side of it, if you look at forests, why don't we reward all forest owners, regardless of whether the forest is under threat, for the ecosystem services they're providing society, right? So I'm going to turn that over to Kurt first, and then we'll see if Pratty or Rich, you know, want to add to that.
I think it's a very valid point, Matt, and I tend to share your perspective here. I think that I think one of the issues is just the overall pool of capital and funds that are available to go into these types of projects, and whether certainly at this point in time, spreading that across all available existing forests would, you know, first of all, could that reach the people on the ground who are often indigenous groups or other existing stewards of that land? Would that actually get there? I think that's one of the sort of one of the issues with that sort of approach at present. But I certainly I share the sentiment. And the other thing around avoided emissions is it does create a perverse incentive for, you know, forests that are not listed as under threat currently, for someone who owns that land to then say, oh, well, actually now I'm planning to do a development here, or I'm planning to do something, and then getting rewarded for not doing that development. It seems like pulling, you know, robbing Peter to pay Paul, or just like some accounting loophole there that's not actually getting us the drawdown that is required. So I share your sentiments. I'm not sure. I think more funds coming into the space, and over time certainly being able to have a almost just like a universal basic income for landowners to that effect would be beneficial. But again, that understanding or having mechanisms in place to make sure it actually gets to people on the ground is that other challenge that currently exists today as well.
Yeah, fair enough. Rich, Pratty, do you guys have anything to add there? Maybe Pratty?
I'll try to answer it, Matt, without yelling. Because the idea that we should focus on, you know, removals only is idiotic. Focusing on removals only is like emptying a bathtub with a spoon and not turning off the tap. We have to turn off the tap. And the number one thing that humans need to do, yes, we need to draw down CO2 from the atmosphere. But our ability to do that is minuscule at the moment compared to our ability to reduce emissions. The number one thing that humans have to do is reduce emissions. And the carbon market does not work on the principle of 1 + 0 = 0. It works on the principle of 1 + -1 = 0. But the -1 doesn't have to be removals. We're just taking the very simple but elegant premise that what is difficult and expensive to do in one place may be less so in another, and we're using the marginal cost of abatement to accelerate emissions reductions that aren't in the developing world, that aren't achievable as quickly or as inexpensively in the developed world. So that obviously relies on the premise that you can prove, which is a problematic, at least from a logic point of view, you can prove an unobservable counterfactual. But for the project, what would have happened? And I get the simplicity of the accounting of removals. You put a ton up, you take a ton out. You plant a tree, you measure the carbon on day 1, you measure the carbon on day 2. If it's gone up, you get paid. That's very simple. But we have to massively increase the scale at which we incentivize the avoidance of emissions. And if you think about technology-based avoidance, which is slightly different to nature-based avoidance, technology-based avoidance is permanent. If that ton of emissions wasn't emitted, it wasn't emitted forever. That's not as true in nature-based solutions. And to the second part of your question, you know, should we just pay people to protect forests? And I think Kurt touched on that. Well, yes, we can, but you can't have it both ways. You got to pick one. You can't say about renewables, we're not going to do any avoidance credits. We're not going to subsidize renewables because of the 1 + -1 problem. But on the other hand, we're just going to go and pay people to protect their forests even if they're not under threat. You got to pick one. Are we financing forest protection and avoidance or not? I don't think you can have it both.
So
I
go ahead, Matt.
it seems like you disagree pretty strongly with what I said. So maybe I'll clarify a little bit. My thinking is I think avoiding emissions, new emissions is great, right? That's really, in a lot of cases, keeping us from increasing our emissions, not actually bringing us down. So what do you think of an approach if we actually taxed all emissions, right? You actually had to pay to pollute all emissions. So that wouldn't that incentivize, you know, new projects to keep them down, and then you don't have that 1 + 0, you know, issue.
Yeah, and not but and a globally, you know, universal and punitive carbon tax could be an effective way to reduce emissions, but it doesn't reduce emissions in of itself. You still have a choice. I can pay the tax or I can reduce my emissions. It still relies on a theory of change that says someone acting economically rationally will reduce their emissions rather than paying the tax. So it doesn't in of itself solve the problem. And the carbon market, and I think this is really important, the carbon market is at the VCM is a carbon tax. But the carbon tax is being leveled by, civil society, is being imposed by civil society, by shareholders, by customers, by financiers. And the market is setting the level of the tax, and that level is too low. So what we really want companies to do, and why we shouldn't be afraid of low prices in the short term, is because we're trying to normalize the behavior of paying the tax. Pay compensation for your emissions. If your Shell's scope 1 and 2 emissions 58 million tonnes a year, and they offset about 2.9 million tonnes of that and were criticised for the offsets. They should have been criticised for the 55 million tonnes that they didn't pay a tax on. And so if we can normalise the payment of compensation, the payment of a civil society-driven tax at low levels, and embed that into the financial system, those commitments become stickier as the price of carbon rises, as the implied tax rises, which then starts to force decarbonisation. So yes, I think a very high, globally punitive carbon tax at the level that the US EPA would say is necessary. The US EPA says $190 a tonne is necessary. The European Central Bank says $300 a tonne is necessary. We're orders of magnitude away from that. So yes, high prices that are globally inclusive would be an effective tool. It's not, we think, the theory of changes, is not an emissions reduction tool in itself. Only stopping fossil fuel burning and chopping down trees is the actual outcome itself.
Sure. But like if let's say you had a target in terms of your emissions, total emissions, and you just keep increasing the tax. If you go over your target, if you increase the tax. If you're hitting your target and your path of change, right? Where you want to get to net zero, and a lot of people believe we have to go net negative, and really that's the plan of the last COP to keep us at 1.5 is we have to go net negative for a while because we're continuing to emit. If you just if you're going over the target, you increase the taxes. If you're staying under the target, the taxes don't have to go up.
But that's how any cap and trade works. That's how the European ETS works.
Sure. So why do we even make it voluntary? Like you're criticizing, I forget if it was Shell or Exxon, you said they offset less than 10%. But it's voluntary for them. Why not make it mandatory? And then you can criticize them for not following the law.
Of course, let's make it mandatory, and let's also invent a technology that sucks every ton of CO2 out of the atmosphere tomorrow. We also have to be pragmatic about what is actually going to be achievable, globally. We couldn't even agree at COP27 what methodologies are going to be part of the go forward emission reduction plan. So yes, totally, a cap and trade in which there's a very high punitive price is where we should all aspire to be. But we also have to be, you go to war with the army that you have, not the one you want.
And if I can just jump in here, right? A couple of sort of points I wanted to add. One is just sort of zooming in a little bit about Rich's comment about, let's say, people not using offsets enough and how much they are actually able to do. So I think in the entire argument, there is a fair amount of double standards with respect to the carbon markets that we see. First, and what that means is that we are always super critical about having the players, both buy side and sell side in the carbon markets, to prove that they are doing something good for the planet. But on the flip side, and measure it accurately. On the flip side, we are not measuring, like imposing the same conditions on everybody else who's not part of the markets, and people who are actually there irrefutably harming the planet, but there is no condition on them to actually measure it accurately and prove and justify why they're doing that, right? So that's the sort of double standard that we notice. And both of those will need to sort of get fixed. And unless we are able to have a great handle on the scope 1, 2, 3 emissions of each of the organization, their nature impact as well, we will not have well-functioning carbon markets because they're essentially antithesis to each other. The second aspect, yeah, go ahead, Matt.
No, go ahead. If you have another point, go ahead.
Yeah, so the second unrelated point is that right now a lot of challenges also emerge because we are looking at everything just from a carbon market standpoint. We should sort of widen the horizon to say that it is not just carbon market, it is supposed to be an ecosystem services market, of which one of the point is carbon, and there are many other observables that we are not able to quantify right now. And collectively put together, all of those will start serving as ecosystem services market, which should get applied to each and every business in the world. And the valuation, it should be reflected rightly, right? So even the carbon markets are mispriced right now, as Rich also mentioned. The actual real cost of emission of these CO2 is actually much higher than the price that we're putting on it right now. And we are not even putting any price on biodiversity, the water pollution, nature impact, and so on and so forth, right?
Absolutely. That was actually my next question. So you hit on that nicely. I'll add one bit of that. How do we, like, you know, your fund, Rich, and I'm not criticizing you. I wish I had, if I had known about your fund, I think I would have invested in it, when you came out a couple of years ago. But how do you avoid it, like the colonialization, like a neo-colonialization aspect where, you know, the financiers come in and they're making a lot of money, and maybe some of the, you know, experts are making a lot of money, and the local people aren't necessarily benefiting from not industrializing and cutting down their trees like you know the developed nations did.
Yeah, we've 100% got to avoid, you know, the fate of the developing world when we were, you know, extracting carbon of another kind, you know, the hydrocarbons and minerals of the past, you know, 200 years. I mean, the way we think about that is, from our point of view, we are running a fund that's going to generate returns for investors, but fairness and transparency, not only the right thing to do for people like us who are passionate conservationists and have spent decades working on community and Indigenous conservation, not only the right thing to do, it's a smart business strategy. And so we build into our investments, you know, profit sharing arrangements, revenue sharing agreements, so that everybody benefits from rising prices, not just investors. You know, cool. We are also taking 100% of the financial risk, supplying 100% of the capital. So in the worst case scenario, let's say in the case of the Article 6 deal that we did with Senegal and Olcott at COP27, the worst case scenario for Senegal is it's getting an investment in massively improved municipal waste infrastructure and revenue as the price of carbon rises and funding for community programs. So absolutely, we need to get out of any sort of mindset in which, and it sort of annoys me a bit when people in the carbon market talk about, you know, nationalization risk. It's not nationalization risk, it's resource sovereignty. That is Ghana's carbon, or Senegal's, or Mexico's, not the US's or Europe's or Australia's. And so, you know, one of the people in the Senegal delegation said last year, it's so great, you know, in this deal that it's being driven from the bottom up. And I said in response, that's only true if you see yourself as being on the bottom. And so we really need to elevate the global south to the head of the table in these carbon discussions, because that's where they're sitting. those carbon-rich forests that the West needs, in inverted commas, don't belong to the West. And so that's certainly how we think about it.
Sure. All right. One final question for you before we wrap up, and I'll add later in the day. We have Fred Fournier from Open Forest Protocol, and so I think he's introducing some interesting things to potentially bring down some of those inefficiencies that Pratty talked about before. But one final thing for you, Rich. I actually have invested in Crane shares, Global Carbon something. Are you familiar with their ETF?
Yeah, they've got a few. They've got a compliance ETF and a VCM ETF.
Yeah, so I think it's the compliance one. And so they trade in futures where you actually own the credits. Am I correct on that?
We can, trade futures for risk management purposes, but we're long physical assets.
Yeah, so you're long the physical assets where that fund is more purchasing the futures, right? Am I correct on that?
Correct. Well,
Yeah.
it's tracking the index, so it's hedging the futures, but yes.
Okay. So like, all right. And, but the reason I throw them out there is because for someone who doesn't have the required minimum to go with carbon growth partners, potentially they can get some exposure to carbon prices going with Crane shares, correct?
Yes, you can, if you want to be long the European and California markets, just go and buy KRBN is the ticker.
Yep. And I have a small position in that, full disclosure there, no affiliation with them. Any last thoughts before we roll on to our next speaker?
None from me. I did all the talking, Kurt.
Kurt,
No,
anything to
thanks
add, or you're all good there?
Nothing to add. I think this conversation just highlights how nascent the space is in reality, and the pools of capital that are flowing currently are really just a drop in the ocean to what's needed. And hopefully, we, having these conversations is an important part of getting the issues out there, because when you sort of operate in a vacuum, that's where misinformation spreads or uncertainty or whatnot. And I think the reality is, there are going to be challenges to implementing it. We just need more. We do need more money coming in, and I think Richie alluded earlier that there's never a doubt that these projects weren't occurring or aren't necessary or aren't needed. No one's debunking the fact that trees and nature-based solutions are an important part of this of this whole process. So let's keep pushing forward.
Cool. Well, thank you guys. Kurt, Rich, Pratty. Appreciate your time and the input, and hope everyone learned something.